When it comes to investing, there are two rules, just two rules. Rule one is don't lose money. You can either eat well or sleep well. Now, when it comes to an investment, the first thing you look at is not how to make money. That's where people make a lot of mistakes. If someone comes to you and says, invest in these bonds, we'll pay you 20% for investing in these bonds, and the government of Venezuela is backing it up. Or you can invest in these bonds from the UK government, will give you only 5%. Which one would you go for? If you save more than 85k in one bank, the risk is that if the bank goes broke, then you don't get more than 85k, even if you saved $1 million. If you're a doctor or healthcare professional and you're worried about investing, and you get confused about investing and things, you worry that it's risky and you worry that you lose money, but you know that you should be investing, and you don't understand concept. When you hear things like ISA, stock and shares ISA, it gets you confused. Then you want to watch this video. This video is a live recording of a live Q&A session with almost 100 doctors and healthcare professionals with burning questions around investing, lifetime ISA, investment that doctors could do even above 40 years of age, as well as how to avoid the dreaded 60% tax trap, and much more. So if you're interested in those topics and you'd like to hear the answers we discussed and the questions that we addressed, then you want to dive into this video. And if you're new here, I'm Dr. Andy Egwim, founder of MONEYWISE.com. I'm an ex-salaried GP, an entrepreneur and investor, and on MONEYWISE.com, we help doctors and healthcare professionals make smarter financial decisions. Dive in. Now, before you talk about investing, there are two things you have to consider. I usually say it this way to our community, to our mastermind community, and even in general community. You can either eat well or sleep well. You can either eat well or sleep well. For instance, here, invested in crypto, it did 5 times, and then, well, she couldn't sleep well, so she had to sell it, and then that was it. If she held on to it, maybe it would be like 50 times, but it doesn't matter. Your financial piece is important. It's not just about the money you make. Now, when it comes to an investment, the first thing you look at is not how to make money. That's where people make a lot of mistakes. I'm a big fan of Warren Buffett, and some of you who follow me know that last year in May, I was in his shareholders meeting in Omaha, and also likely going this year as well. Since I was a teenager, he's influenced a lot of my thinking. And he says two things. When it comes to investing, there are two rules, just two rules. And rule one is don't lose money. And I'm sure some of you know rule two. What's rule two?
Do not forget rule one.
Something like don't forget rule one.
Do not forget rule one. Very impressive. That's Raj and T. Yeah, I'm very impressed. I'm proud of both of you. Right. So rule one is don't lose money. Rule two is don't forget rule one. So most people lose money in investing because they start with they want to make money first. No. You start with let me not lose money. It's not fear. It's called risk management. So you've got to understand what level of risk are you taking in order to make this amount of money you want to make, okay? So what level of risk are you taking in order to make the money you want to make? I'll give you a quick example, okay? If someone comes to you and says, invest in these bonds, and this bond is, let's say, from the Russian government, or let's not use Russia. Let's say is the government of Venezuela, my favorite, Venezuela. They say invest in these bonds, and we'll pay you 20%, okay, for investing in these bonds. And the government of Venezuela is backing it up. And then the same person comes back to you, say, or you can invest in these bonds from the UK government. We'll give you only 5%, okay? Which one would you go for? Anyone? It's open. Remember, it's a challenge. It's not a lecture.
UK government.
UK government. Anthony. Okay, brilliant. Okay, Dan said UK. Does anyone in the comment? Malika said UK government. Okay, not to put anyone on the spot. Anyone who wants to answer, if you just open your mic and answer, why would you go for a lower return from the UK government? Malika or Anthony? Anyone of you that feel like it?
Okay, I want to go for a lower return because of assurance, like in terms of stability of the government and predictability that I will get my money or my return back based on past records or antecedents.
Absolutely, that is an excellent return. Does Malika, do you have a different opinion? Do you have anything to contribute in that respect? Okay. All right. Okay. So basically, Anthony said assurance. Another word we use for that assurance in terms of investment terms is risk. So he's going for the one where he thinks my risk is lower. Or in investment terms, it's called default risk, the risk of not getting paid.
Yeah, I mean, basically, I'm same as Anthony, like, because I mean, I usually look for FCA approved things so that there is some guarantee to my money, rather than looking at high return and then you don't know where you're investing. So I'm a little bit risk averse, but 5% is not great, but it's a good return, I would say.
Excellent. Thank you. Let's say Malika looks for FCA, so Financial Conduct Authority approved. That's another way of reducing your risk. You want to make sure they are legitimate to start with. But she says she's risk averse. That means she's like many doctors, because 73% of doctors don't invest, and another 67% think investing is risky and complex. So the same qualities that make you a good doctor could actually hold you back for your finances because you're risk averse. Okay, so being risk averse is not a bad thing. It's just basically understanding where your limitations are and then seeing how you can invest based on your own risk appetite. Good. So that being settled, we already understand what risk is. So now going into the asset classes, with that thinking in mind, we'll start with cash. Okay. Some people have said cash is trash. And looking at different things you can invest in, and then we'll look at risk, because that's the best way to understand risk. If you say cash is trash, a lot of you might find a 17-year-old YouTuber saying cash is trash. Invest your money in crypto and this will happen. But is cash really trash? Really, when the market is down, cash is not really trash. But the problem with cash is that the returns that cash can give you, if you save your money just in the bank, okay, you did not invest it, you just put it in a savings account, then who knows the interest rate? What's the best interest rate you can get? If you just comment in the chat, the best interest rate you can get, if you just save your money in the bank, the best interest rate. Just give me a percentage in the chat. Just tell me in the chat and see. Okay. Everything. Oh, we don't have any savers here. Oh, okay. We only have investors. I'm sure you're saving your emergency fund. Okay, 4%, 45%. See, wow, where? I'd like to join you. Esther.
Sorry, it was supposed to be percent, 4%. No, 4%.
If you get 45% for saving, you're taking no risk at all. Then let's go there. Okay, you meant 4%. Esther said 3%, Dan said 4%. Thank you, everyone. So if you save your money in cash in a normal place, isn't it said 5%? In a normal setting, you save your money. In a normal setting, you're not taking any risk, right? Because it's just in cash. You should be able to go and get your money out. But those of you who were here yesterday, remember that I said if you save your money in any account that is not a cash ISA or a type of ISA, if you make any savings interest above your savings allowance, which is 500 for higher rate taxpayers and £1,000 for basic rate taxpayers. If you make any interest above that, then you have to pay tax on your savings interest. But that's not what this is all about. We're just saying in a normal savings account, you should be able to go anytime and get your money. You're taking less risk compared to somebody who is buying a villa in Austria to rent it out. If somebody's saying, I'm going to buy a villa in Argentina and my cousin is living there, then your risk is much lower than that person. Do we agree on that? Right? Just give me a thumbs up if that bit is clear. Okay. So that bit is clear. Lovely. Thank you, Esther. Now, so apart from things going wrong, thank you, Malika and Obi. So apart from things going wrong, for instance, if your bank that you saved your money goes broke, it goes bust, then that's the risk you get just for saving cash. Okay. Now there's something called FSCS approval. Basically, if a bank has FSCS cover, I think a financial services compensation scheme, you can save up to £85,000 in that bank account. It's a sort of insurance that if the bank goes broke, then the government or FSCS will actually pay you. They guarantee the money you save in an account up to £85,000 sterling. Okay. That bit is important. If you read my newsletter that I send every week by email, you must have read it 2 or 3 weeks ago when I was talking about if you save more than 85K in one bank, the risk is that if the bank goes broke, then you don't get more than 85K, even if you saved $1 million or $500,000, whatever you saved. So that's one of the risks of cash. But generally, cash is considered safe. That's when someone says as safe as you can take it to the bank, or someone say as safe as the banks, or whatever that expression is. So that's cash, number one asset. Okay. Obviously, another risk to look at still under FSCS. Some banks share the same license. I think like NatWest and the Royal Bank of Scotland, they've got the same license. So if you've got 85K in NatWest, you've got 85K in Royal Bank of Scotland, you're only covered for 85K because they are basically have the same license. If you're unsure, check my last email and maybe we'll chat about it in the group chat much later. So this is just the risk associated with cash. The other risk associated with cash is things like inflation. So basically the value of money seems to get lower and lower and lower. And we are all adults here. Nobody here is below 20. So you know that value of money, well, if you are below 20, let me know. But the average person that follows my stuff and content, they usually be between 30 and 55. So if the value of the money you had 20 years ago is obviously able to buy less and less and less, that's inflation. Okay, so that's cash. Is there any confusion around that before I go into more, the more in-depth stuff with risk? Okay, if so far you understand the cash and FSCS, if you just give me a thumbs up so I know you're there, you're following, and okay, you're still on the screen. Thank you so much. All right. 7. There are 7 steps to take before you even start thinking of investing as a doctor or healthcare professional. Now, this is really important to secure your financial foundation before you start investing. Now, I've covered these 7 steps in a simple guide that I've made available for you in the link in the description. You can download it. It will help you to build a solid financial foundation, avoid common investing mistakes, and also make tax-efficient investment decisions. Start your investment journey the smart way. Download the guide now using the link in the description, and good luck on your investing journey. Now, let's get right back to the episode. Now, we've counted cash because I consider cash as a type of investment, and that's why I say you should have an emergency fund. And for those of you like Daniel who were here yesterday and you did the exercise, you ticked up those 7 things. One of the 7 things we recommend you should do before you start investing was to have an emergency fund. Okay, if you don't have the guide, the free step-by-step guide, 7 things you should do before you start investing, after this session, just comment on the WhatsApp chat and someone will share it with you. You can download it. It's totally free. So cash is one of them. So your emergency fund saved in a tax-free account, if it's an ISA, that's a good place to start. Now, number 2, moving up the chart of risk. You can say I got rid of the slide so that I can just focus on it clearly. If you are moving up the chart of risk, the next type of thing you can invest in, again, if you don't want to invest in cash, but you wanted to invest in something that you want to be sure that when you come there, the value is not going to be changed based on the market, what would you go for? Just give me your answer in the chat. You don't want it to be affected by volatility. In said volatility. Volatility basically means up and down. I think it's coming from water, the way water goes up and down, ebbs and flows. So if you were to invest in something that you don't want to be affected by volatility, you don't want it to change based on the change in circumstances or the market forces or anything, can you tell me in the chat what you invest in? Okay, so I'm waiting for the answers because I know. Okay, gold. Wow. Okay. Bonds. Okay. Bonds. Okay. Yeah, Muriel, I like that. Maybe later we can talk a bit about gold, but obviously gold, the value of gold can go up or you can go down. Or rather, we can say the value of gold stays the same and it's the value of money that goes up and down. Okay, so Chi said bonds and WN said bonds. Okay, lovely. So that's the next thing. When we move on, real estate treasury bonds. Okay, that's good again. But we also know the value of real estate that's a great answer, by the way, Esther. I will take the treasury bills, but we know that the value of real estate can go up, it can go down. So talking about risk, there's a risk in real estate. You know, we've moved on from cash, where there's almost no risk. The next level is something else that doesn't have that much risk attached to it. Okay, so we said bonds. The problem with real estate, for those of us who were investing in 2008 when the market crashed, I wasn't investing in the US, I was investing in Nigeria, I was a medical student, but some real estate, the value just dropped. Okay, so that's a bit of a risk. So I'm going to put real estate outside this category, but I'm going to take things like bonds, treasury bills, you know, things like notes, anything that is a fixed income asset. And I know that majority of us, or even all of us here in the UK, maybe one person is not. So, you know, you've heard about gilt, G-I-L-T. Not G-U-I-L-T. So gilt, I've just put it in the chat. So when you hear gilt, basically they're talking about bonds, UK government bonds. Okay, that's a type of bond. If you hear about treasuries, they're talking about US government bonds. I'm sure, okay, for some of us who are IMGs as well, your government, the country you've come from, your government also floats bonds. Like I'm originally Nigerian, and Nigerian government floats bonds every now and then. Okay, so it might be called bonds, it might be called treasury bills, it might be called gilt. Basically, what it is that it is fixed. The value is fixed. We call it FIA, fixed income asset. Okay, fixed income asset. So bond, treasury bill, and how does it work? Basically, okay. Is treasury bill different from bonds? Okay, I'll answer that in a minute. So basically, what it means is that whether it's treasury bill, or if it's called bonds, or if it's called government treasuries, or if it's called different names, or if it's called gilt, just think of it as debt. D-E-B-T, debt. Once you understand it as debt, then don't worry about what the name is. Okay, yeah, actually, that's a good question. Sometimes treasuries are usually shorter. 1 year treasury, 2 year treasury, 6 months treasury, while bonds, you tend to see like 20-year bonds or 30-year bonds, 5-year bonds, but don't even worry about the names. Just know that they are debt. You're investing in debt or fixed income assets. Okay, fixed income assets. What this means is that you're not going to be surprised, okay, if you buy stocks like, invested in crypto and it went up 5 times within 12 months. Or for instance, I invested in Facebook when the market wasn't that good, or when Facebook was struggling. And I'll say that particular stocks, we've done 3x on it. And I've got shares I've held since 20 years. I don't know if they would, they've done really quite well, but I can't tell if they're going to do 100x or 20x or whatever, or whether they will disappear. Of course, I know the companies are high quality companies, but with bonds or treasuries or gilts or whatever you call it, with fixed income assets, there shouldn't be a surprise. So if you buy the bonds, you've lent money to the issuer of the bond. So if you buy the bonds, you've lent money, so you are a lender to the issuer. So and there's a fixed income. It might be that, let's say the income is going to be 5%. So basically, you're going to get 5%. If the income is going to be 10%, you're going to get 10%. It's fixed income right from the beginning. There's no confusion about it. A typical example, many years ago, a colleague of mine who is also basically in our community bought a bond, okay, for a 20 years bond, basically. And when he bought the bond, I think it was getting 9% return, okay. And he's been getting, I think the bond is about 10 years roughly now. So that 9% bond, let's just say he bought the bond for 100,000. I'm just giving a rough number. 9% of 100,000 is what? Those of you who are switched on, your math brain is on. 9% of 100,000, that should be an easy one.
9K.
9,000 pounds. Again, this is just numbers I'm giving you here, but it's getting 9% annually. So what this means is that if you bought a bond and you bought a bond worth 100,000 pounds, you should be getting returns on the bond. So in the past, we used to get coupons that you can, clip the coupons and cash it in. You mail it in and they pay you cash. Now it's all electronic. So if you buy a bond, let's say you buy a government bond paying 9% and you put in 100K, you're going to end up with 9,000 per year for the next 10 years. And after 10 years, you get your 100,000 back. So that's fixed income asset. No surprises. You're not going to double the money or triple it or anything like that, but it's just fixed. The problem with that is that the safer the bond, the safer the bond, the more people want it. Safe is relative. But if the lender is somebody that is likely going to be able to pay back, then more people want that bond. And if more people want that bond, the lender can say, yeah, we're not going to pay much interest, okay? For instance, if you want to do a quick one now, you can just Google UK gilts, 10-year gilts today. I'll tell you what that is in a minute. So UK 10-year bonds. If you hear gilts, just replace it with bond. UK 10-year yield is 4.4%, okay? That's what they're going to pay you, 4.4%. So if today you wanted to buy UK government bonds, you're going to be paid, or what you're going to get return on it is 4.4%. So for the next 10 years, from 2025 to 2035, you're going to get 4.4%. That might sound like a good return until you look at the rate of inflation in UK. If you look at the rate of inflation in UK as of December 2024, the UK's annual inflation rate was 2.5%. It's come down from 11.1% in October 2022, which was the highest rate in 40 years. So in October 2022, the inflation rate went up to 11%, which is the highest. Many of us are not even 40 yet. So inflation can go up or down. And when inflation goes up, bond suffers because it's a fixed income asset. It's fixed, it can't go up. If inflation goes up, your bonds become less valuable. You still get the same money paid to you, but nobody wants to buy that bond, okay? But if inflation goes down, then your bond is considered much more valuable. So you can even resell the bonds in the secondary market. Well, I hope you found that helpful. And more importantly, I hope it helped you to see investing in a new light. This is just a small section of what we cover in the full masterclass. If you'd like me to drop more of these clips, just let me in the comments. Comment invest and share this video as well with friends who may need to hear this. And if you are ready to stop winging it and guessing, guesswork is not good for investing. If you want to learn how to become a confident investor, to learn how to invest properly, check out our investing readiness scorecard with the links in the description. It will help you determine whether you're really ready to start investing and what you need to do before you even start thinking about investing to reduce the chances of you losing money. And until then, see you soon. Bye-bye.